independent examination of an organization's financial transactions and statements and its reporting by the auditors in order to provide a clear, unbiased, and objective evaluation is termed as financial audit. Financial audit is conducted by the independent authorized auditors, or CPA/CPE firms, to report accurate financial documents, to reasonably assure that the financial documents presented by an organization are impartial in all material respects and provides the stakeholders with a true review of the company's financial position, in accordance with the Generally Accepted Accounting Standards, GAAP. The aim of financial audit may be disclosure, compliance, taxation, setting internal controls and other legal purposes. Audit training increases the value and integrity of financial statement produced by the management. The auditor gathers evidence through different auditing procedures including interviews, observations, and test work to check the financial statements for material error, or a deviation from the set accounting standards. Types of financial audit. There are basically two types of financial audits being conducted by companies. 1. Internal audit. The type of audit conducted by an organization in-house, in accordance with its own set standards. Internal audits are performed in order to evaluate organizations' operational efficiency, internal audit courses, and accounting processes. It is performed usually by a company's own professional, or an external consultant, if there is no internal professional available. External audit. An audit that is conducted by third-party firm, or a professional, who doesn't work for the company. It increases company's legitimacy to lenders and investors, that all company records are complete and clear, and that the company has nothing to hide. It is normally performed by a company once a year. CPA/CPE courses firms examines below mentioned documents and statement to assure a company is following basic accounting framework. Basic financial statements examined by auditors are income statement, balance sheet, and cash flow statements. However, the auditors may look for other documents too, depending on the type of business and the purpose of audit being conducted. The process. Planning and risk assessment. In this initial step, the audit team is put together with the general guidelines of how the audit will be carried out effectively. The auditor needs to have a complete understanding of a business and the industry it operates in to identify risks that could impact the financial statement in the next step. Testing internal control. In this step, the auditor analyzes the internal control perimeters at the company in order to safeguard its assets and any material or financial misstatements. It provides sufficient information about company's internal processes of preventing its employees from performing fraudulent activities. Testing. Here, certified internal auditor looks for evidence to identify any error or misstatement in a company's financial documents and accounts. The facts, figures, and claims reported in the financial documents are cross-verified to look for considerable evidence. This may include physical examination of assets, cross-verification of facts, and figures recorded in financial statements against actual records. Reporting. The final step of an audit is reporting. Here, the CPA firm or an independent auditor provides a conclusion whether or not the company being audited cling to the Generally Accepted Accounting Principles, GAAP. An audit report is usually published with the annual report of the company. It is this report which is required by the banks or lenders before making lending decision. A qualified report is an evidence that company followed accounting standards, whereas an unqualified report indicated that there are misstatement or error in company's financial statements. An adverse report means that the company didn't follow GAAP, and it had discrepancies in its financial statements.